Welcome to the ROI Masterclass, the podcast where vision meets strategy and bold moves create measurable results. I'm Liat Siegel, interior designer and ROI strategist with 17 years of experience. I help businesses transform properties and ideas into high-performing assets. This show is specifically for real estate investors, hospitality operators, and boutique developers who aren't afraid to take risks, challenge the status quo, and demand a return on every decision they make. Each and every week, we talk with innovators and leaders across industries about the strategies and the insights and really all the unconventional thinking that turns potential into profit every single time. If you believe that smart design, decisive leadership, and strategic risk are the keys to real ROI, you're in the exact right place. Let's dive in. Today's guest is Sitta, a multifaceted real estate professional with a background in engineering and deep experience across acquisitions, operations, and capital strategy. After scaling from small property deals into owning and operating apartment complexes, Sitta transitioned into advising investors and developers and now specializes in capital brokering, connecting sponsors with institutional equity and debt for large-scale real estate projects. With a strong national network and sharp understanding of what capital partners look for today, Sitta brings a grounded perspective on ROI, deal structure, and the role of strategic relationships in getting deals funded and executed. Thank you so much for joining us today.
Thank you, Leah, for having me. Happy to be here.
Talk to us about the financial side of real estate. There's obviously a lot involved. In our last conversation, I believe you mentioned that one of the biggest blockages in today's market is raising capital.
Yeah, it's very tough. And, you see kind of what happened after they raised interest rates. Of course, the cost of capital went up, and it has multiple effects because a lot of times on the sell side, a lot of sellers aren't selling, just because when they raise interest rates, they're not going to be able to exit at the price that they wanted. So it's making it to where there's a spread between sellers and buyers, so deals aren't getting done as much. And then a lot of equity is super tight right now. Even debt is a lot more strict on, how they're lending money. So it's just very tough to get deals financed. It's leading people to be creative. And in some ways it's good because you have to be more disciplined as an operator. I think prior to that, there was just a lot of deals that shouldn't have been done that were done. So now we're kind of seeing a correction in the market.
So how are operators getting around that? Are they just not? Are they doing less deals? Are they finding creative ways? What's happening on that side?
Yeah, so there's a little more creativity, and there's also some differences in how they're actually capitalizing deals. Pre-2022, 2023, there was a lot of bridge debt on, value add, which is kind of what we're seeing now. A lot of deals that are maturing because they had short-term loans. Now we're seeing a lot less leverage in deals. You're seeing people get up to 75, 80%, even 85% leverage. And you still see that sometimes here, but now people are going for a lot less leverage to mitigate risk of just having a higher mortgage. So that's one way. And then a lot of the deals now are being done by very strong sponsors. And you kind of see a shift, just being in the industry. A lot of people have left to transition to other assets or other investment types. The people who remain, you have those people that are there, they're kind of in it for the long haul, and they're stronger sponsors. They have more background, and they're a lot more stringent in underwriting because they know that capital is going to look at deals a lot closer than they were before. So you're seeing a lot more discipline, a lot more fundamentals, coming into play. And I think it's better for the industry because it'll mean, more realistic valuations and deals that are actually going to last.
So with that discipline, do you think that also, obviously the underwriting needs to be tighter too? Do you see the allocation of capital also being stricter and them being more strategic with how they use it?
Oh yeah, they're definitely stricter. Like even coming down to like getting a term sheet, they're a lot more stringent now. Like they want to see everything up front. They're leaning heavily on trusting the sponsor, making sure the sponsor can execute more than everything. And that's what they're saying is you bet on the jockey, not the horse. So you want to make sure that you have strong sponsors. So a lot of times they're looking for financials up front. They won't even, issue a term sheet in some cases without financials. They won't even, really start looking at this or really engage with you unless they see like a REO up front and see that you have the experience to actually get the deal done. And then once they get into underwriting, then it becomes a whole thing. And to the point where you can have a deal, get initial terms and get through underwriting, and then just capitals, they're finicky sometimes because, sometimes they don't want to deploy capital, but they don't want to have the reputation of not deploying capital because of course that's their business. They want to still get deals in, but what they save versus what they're actually going to fund. Sometimes there's a discrepancy. It's been a tough market. A lot of lenders been burnt. A lot of equity's been burnt. So they're just doing what they can to protect their own interests.
Do you think it's been burnt because of just how tight the margins have been?
It's a few things. So one, it was the market turning when they raised interest rates. Deals that made sense just didn't anymore, and people are already invested in these deals. So there's been a lot of distress just from that reason alone. Two, expenses and everything went up. Like after COVID, wages went up, insurance has gone up. At the same time, rents have decreased because you had this huge supply boom over the past few years, especially like in the Sun Belt. You got a lot more apartments being built. I'm speaking specifically for multifamily, a lot more apartments being built. So that's driving your vacancy up. So your revenues decrease at the same time your expenses increasing. So the margins are a lot tighter. Then capital is more expensive. And then of course you got asset classes like office that still haven't fully recovered from the pandemic. So, there's just a lot of different factors that are coming into play. And then throw in government and administration change and uncertainty. And, we can invade Poland tomorrow. There's not so much uncertainty. It's just making it very difficult to operate.
Is there any lever that can be pulled in order to increase margins, or is everything just a constraint right now?
The best things you can do, and the result is fewer deals are getting done. You have to make sure that you buy right. You have to make sure you buy right and you actually know how to operate. I think in the past few years with from 2010 to like 2022 is like the golden age. And specifically, again, speaking on multifamily, is because that's what I understand the most. Like 2010 to 2022 is the golden age of multifamily. You could literally buy a deal, be losing money every month, and then exit for much more than you bought it for and make a whole bunch of money, make out like bandits in a year or two, just because the market was just
It was crazy.
People, I could get my 2-year-old nephew and have him, run an apartment. He probably would have made money in 20. You didn't need to do anything, and then that attracted a lot of people who aren't really dedicated to actually, because it's tough to run an apartment in any market, but in a market where the margins are this tight, this is incredibly tough. So you got to make sure you buy right, and you got to be very focused on your asset management, and then kind of focus on the trends, see where everything is going, and invest for the long term. And that's really the only way to be able to be successful.
I've wondered if one of the other levers that is kind of underrated right now is also how CapEx is spent. That, oftentimes, when you're doing underwriting and you're figuring out if a deal is good or not, there's not a lot of data on what kind of capital you're going to spend is going to bring what kind of return. So, it's a guessing game as far as I understand in terms of, renovations and value add, and nobody really knows what is going to drive what uplift. Is that a good estimation?
Yeah, I think that's fair to say, because that's a huge part of your budget, right? How you gonna, if you're doing like a value add, or even like if you're doing development, there's could be a wide range of how you spending your money to create certain finishes. And a lot of times it is a guessing game, and most groups don't have the scale to be able to really have good data that says, oh, if we invest XYZ into this type of finish or these type of amenities, then it's going to lead to XYZ. So basically everybody's just kind of looking at, all right, what's already existing in the market and what are they able to get for those rents. But if you're trying to push the envelope and drive ROI up even higher, that can be very difficult. And it's just, it is just a guessing game. That's not something I've dabbled into as much. I've been more on the workforce housing and affordable housing side of things, where you're not really trying to push rents to the highest. But, when you're A class, like, I'm seeing some of that from the capital side, like just the high end amenities, and you're literally dealing with a completely different demographic of people that can afford those things. But again, you kind of got to test the waters and see if it's going to be worth it.
Absolutely. I guess that's where somebody like myself comes in, because we are testing and figuring out and reverse engineering and creating the science behind what makes a property be able to, have the highest uplift. How do you spend, CapEx so that you have the maximum uplift, right? And not just have it be a guessing game, because we have all these backwards facing metrics of what has happened and what has worked before, but we don't really have, until, my husband and I have built that out into an ROI calculator of what kind of finishes and what kind of packages and amenities will help increase that uplift and ultimately help utilize that CapEx better. What are you seeing in terms of, you said workforce housing also, do you think that occupancy is one of those, yes, you can't push up the rents, but owners can and operators, they can lose money if properties are sitting empty? empty. I know that you don't have that in every market because there's those that are always full and you have sometimes a waiting list, but Sunbelt region where you said that there's a lot of more competition now, are you seeing that even with those finishes and even for lower class properties or workforce housing, that occupancy is one of those drivers?
Yeah, occupancy is definitely one of the challenges you have to deal with, and you have to maximize it. And that is gonna, like, your finishes are definitely gonna have an impact on that because being able to show a unit that has all the upgrades that is comparable to another unit that's like a classic unit, maybe 20 years old, renters are gonna go for that all day. Another side to that, outside of the finishes, is like your operation and your on-site management. Do they have good systems for leasing? Do they have good systems for turning units? Are they marketing effectively? And that's something that, like, at a granular level, it can be tough when you have, especially like third-party management, especially with like workforce housing, because when you're dealing with workforce or affordable housing, especially affordable housing, your property managers are doing a lot more than just, collecting rents and showing units. Sometimes you're doing like damn near caseworker type of stuff. You're dealing with people that are living paycheck to paycheck, losing their jobs, and sometimes like even the finishes can't keep your property occupied. You're gonna have high turnover just because of the clientele you're dealing with. So the best way to mitigate that is just having smooth systems, proper verification processes, and a strong team that can help mitigate that length of units sitting vacant.
Are you seeing though that the property, a lot of the like biggest complaints and objections that I hear a lot of operators say is that just having a property manager is also, it takes a huge chunk of the margin. Are you seeing that as well? Like that eats in tremendously?
I would say it's not necessarily the issue of them. You mean like the management fee taking a chunk of it? I would say that's not necessarily an issue in itself. It's just like the value that creates. And you'll see a lot of operators, or like, if you're in multifamily, really even other asset classes as well. As soon as they get the scale, they want to vertically integrate and start their own property management. And it's not because everybody loves having a property manager. It's not because of that at all. It's because it's very tough to have somebody third party take care of your asset the way it needs to be taken care of. And a lot of times the incentives aren't strong enough because the amount of work that it takes to go from a property being 91% occupied to being 97% occupied is a significant amount of work from your on-site staff and your property management. But the gain from them, because it's just a percentage of revenue, typically isn't going to be high enough for them to be incentivized properly. So you got to put in the proper incentive structures. What kind of bonus structures? Is there ability for them to really see the benefit as well from driving that occupancy up? And that can be very tricky when the margins are super tight to put those incentives in place. So that's one of the issues, man. We've turned to self-management on a couple of our assets for that reason.
Wow. So what does an operator do? I mean, that sounds like their hands are pretty much tied, like you mentioned, doing it yourself, but that's very tough.
Yeah, I mean, if you want to do like third party, the best thing you could do is, of course, get referrals, hire somebody that's strong, particularly in that market. We've had situations where property management came recommended, but we had a poor experience, and, come to find out they're a lot stronger in like their home market, which is in another state. Whereas like in Atlanta, they don't have as much presence, so they're spread a little thin. So you want to make sure they're strong, particularly in that market and with your specific asset, and then find structure. Really look into that PMA, that property management agreement, and push back. Don't just sign something that they sent you and say, like, yeah, this is how you guys do business. Look at it, push back, put in your own clauses, see where you can structure certain revenue on their end to be incentivized and success based, so you don't have to deal with them just collecting a check to not do anything. Just having that and making sure that you guys are on the same page and your interests are aligned goes a long way to be able to execute. And if that doesn't work, you got to self-manage, find, you be able to build it out. It's not as hard as people think. You just have to be able to find the right people. And then if you have scale, it becomes a lot easier.
Yeah, I like what you said about systems. I think systems are everything. It doesn't matter if it's your, finish plan and materials that you're putting in and CapEx, or property management, or, raising capital. Systems will literally help you scale and create a winning system that can be repeated again and again and again.
How have systems helped you in your business? I'm curious to hear that.
That's what we do in our sleep, is create the systems for investors, developers, and hospitality operators so that they don't have to have that guessing game in terms of CapEx, right? And that we can literally create that repeatable design system so that they can hand it off to their contractors, to their team, and say, this is the exact roadmap that's going to lead to the highest ROI. Because the market wants something very specific in terms of finishes, and it's not gray anymore, right? Gray is out a long time ago. And And, appliance lists, we don't have to redo that every single time. If you have the systems in place to say, I already know when I'm going to do my underwriting, I already know what I need, and it's already optimized for the least amount of money, right? You told me in one of our first conversations, you said, the only thing that I want is to reduce expenses and increase profitability. That stuck with me. I really internalized that, and the systems help do that because it's the guessing that always costs more.
Yeah, no, once you figure it out, you don't want to reinvent the wheel. You can maybe tweak it and improve it over time, but at least you're starting from a base point. And I think it's interesting because I'm sure you found a balance of like having a repeatable system, but with you guys being designed, not making it so cookie cutter that, everything looks the same so that there is some kind of uniqueness. I'm sure that's a balance that you guys had to figure out.
I love that because it's one of the objections that I hear all the time. And I smile because it really depends on the asset class, right? It always comes down to never trying to just push maximum work and making, for myself, could I do that? Could I say to every, client, sure, I'll create a custom plan for you every single time and make more money. But I don't want to do that because the investors will save more money. Their margins are already so thin. If you have that repeatable cookie cutter system, you can layer on top of it customization, right? And you have a library of finishes that can, no matter what you pick, you mix and match the flooring and the lighting or the paint colors. And no matter what you pick, it still works. And it's not like some green undertone and then like, pink undertone and it looks like a nightmare, because that is what we've pre-selected, and we've figured out the science behind what will map to the greatest return on investment for that specific market. And you can layer customization, you can do custom floor plans from there, you can have a more interesting lobby or carpeting in the, if the hallways, if it's more A-class property. So there's lots of different things, but the bottom line, the basis of it, the foundations of it can stay the same as that repeatable system. So let's rewind to who you are. Like, you started in engineering, right? And now you're in real estate. What does that look like, and how did that impact what you do today?
Yeah, it's funny. A lot of engineers end up in real estate. I think I heard a joke a long time that said the most direct path to a career in real estate is through engineering school. And you see it a lot. I think there's a lot of similarities. You're very process oriented, you're very like efficient. So, just being able to scrutinize ROI, your underwriting. Like when I got into multifamily, I started off like just learning how to underwrite. Like that was my value to the partnership in the beginning, was just being there. And I picked it up just, I never went to school for any of this stuff. I've never worked for like a major firm. It was just kind of everything self-taught through the internet, books, and then talking with people who had more experience. So I knew I was on the right path. But like it was just relatively easy picking up the analytical side, because real estate math compared to like engineering math is like night and day. So it was pretty easy to pick up. And I think now it's like, just the numbers make sense a lot more. The workload, I've been full-time entrepreneur for almost 4 years, focused on this industry. So I've, been wearing many hats, and a lot of that stuff is like, I've been doing, just having that kind of workload and hustle, being able to manage different streams, being able to figure things out and solve problems. I learned a lot of that in school. So like, even though I don't use my degree directly, a lot of what I learned transfers over. And yeah, you go anywhere with a Georgia Tech degree, engineering, you can figure out pretty much anything. That's what I always say.
That's incredible. Is one more work than the other? Like, is it now that you did engineering, now you're like, oh, this is a walk in the park?
Well, I would say it's different. So it's a different type of, everything is a struggle no matter what you're doing. There's challenges to it. With like engineering and being in engineering school, I haven't been as challenged technically since I left school. And that's true even if I stayed in engineering in the role that I was in. You're typically not challenged as much technically as the stuff that you have to like go through technically at an engineering school. You're not going to see that in the real world. But the challenge is more so like with people, and how do you manage emotions, and how do you, sell to people? Sell is just like persuading somebody to do something that's beneficial for them anyway. How do you have the confidence to handle certain situations? Like, it's a lot different. It's a lot more soft skills, but having the technical skills and analytical skill is great, and it's a part of it, but a lot more value is just how do you actually interact with people? And that's something I've always been big on, read a lot of books on. I think that's really what allowed me to make the transition a lot smoother.
That's amazing. I love the technical side of things. things I often get. You look like a designer, you also sound like a designer, but you also sound like you're an investor. I equate that also to all the technical side of things that are so important in order to be successful in the real estate industry. Like you said, it's the analytical side of things that really make a difference in terms of whether a property is going to be successful or not.
Yeah, you gotta, numbers have to fit. They gotta make sense. And if you don't get those wrong, you have no hope. And then you really don't. Like it's like you buy it, it's too expensive. Like there's nothing you can do. You can operate that property for the next 3 years as efficiently as possible. You bought it too much, it's not gonna work out for you. Unfortunately. But if you buy it right, you then still have to be able to, deal with people, manage a team, make sure morale is high, handle challenges that will surely arise. And a lot of that is going to be soft skills and just how do you manage that. And it's a balance. It's like you got to have many skills, or at least within your partnership, have those skills. If one person's more technical, somebody else has to be the people person. You can't just have two robots. It's not going to work.
Yeah, absolutely. That's one of the major things that I've learned from all the incredible investors that I've interviewed is that partnership is the number one key to a successful venture.
Very much so. And that's one thing that I've learned. I've always partnered with everything. Like I've been, kind of sole proprietorship in my business, but I partner with people on pretty much everything, even in capital brokering space. Like I have a couple guys that I reach out to that we can work on stuff together. And it just allows us to expand our opportunities and expand our network of capital sources. It is a team sport. Like you're not going to be able to do everything by yourself. And if you try to build that skill, it's going to take you 30, 40 years. And by the time you build those skills, new skills are going to be required. So you got to find a way to niche, figure out like, all right, this is my role. This is what the position that I play. And I'm a partner and team up with people that play the other skills so we can win. Like I always say, like Michael Jordan, LeBron James, Kobe Bryant, you think of like the best guys that ever played, basketball. And you look at how many rings did they win. And, Jordan had 6, Kobe had 5, Bryant got 4, 5, whatever. But anyway, you ask the question of how many would they win if it was just them? They wouldn't win any championships. They wouldn't win a single game playing against a whole other team of people. So you can't just do everything by yourself. You're always going to need other people around you that can just lighten the load and get things done.
Yeah, I love that analogy so much. And also likewise, in terms of the shots, like it's also going to be full of failures. I think it was Michael Jordan also, right? What's that quote that he says, the number of shots you take, right? In order to get that win, right? So Tell me now about the capital raising as well. Like what does that look like on a day-to-day basis? Can you guide our audience in terms of how to tackle raising capital?
So I think the first thing as a sponsor that's looking to do a commercial real estate project, you have to be realistic about your ability to attract capital and kind of know where you fit in. So, like a lot of the equity groups that I talk to, they're institutional. There's a certain profile of sponsor that can attract institutional capital. And there's not a lot of sponsors that can. Just they're very particular about who they invest with. They're writing $20 million checks and it's other people's money and that's their entire business model. So they want to see extensive track record. And most sponsors just don't have the track record that would entice institutional capital. And that's okay. You can, if you want to go for it, then, have co-developers or, co-sponsors co-GPs that can help you attract that. And if not, figure out what works for you. If you're going to do something like a syndication, if you're doing friends and family, then, go that route and build your whole business model around that. And if you want to get institutional, you got to, figure out another route. So I think that's the first thing. 2, be realistic about your deal and the capital it can attract. It's like we spend a lot of time going through these deals, whether it's an acquisition or a development. And it's like the deal is your baby. And it's like sometimes you think your child is the best and you wonder why, they're having a tough time attracting a partner or something like that. It's like, well, maybe they're not as great as you think they're the best because, as your child, you raise them up. But in the grand scheme of things, they may not be the most attractive to, what's out there in the market. And the same thing goes with, deals. You work so hard on it, you put your heart into it, you feel like it's a great deal, but it might not be. So you got to be realistic about the flaws. You got to be realistic about the risks, know those up front, and have a plan to mitigate. And then as far as like to raise capital, it's heavily dependent on network, no matter how you do it, whether it's institutional, whether it's, retail, you're syndicating, it's all about network. So you can't be afraid to network in this industry. You can't be shy. You got to be willing to talk to people, talk to strangers, create content, have conversations. You got to talk to a lot of people. Or if you don't want to go that route, talk to somebody like me who's, has those relationships and is happy to do those things, because it's going to take just as much time capitalizing your deal and figuring out the financing as it is actually doing the deal when you get to, the commercial level. So either it's going to be you doing it or somebody else doing it, but you got to figure it out.
I like what you said in terms of leaning on other people that have more experience than you do, or a different set of skills or experience in a different field, because that is literally, no one can really go at it alone. And if they lean on somebody like yourself to help them raise the capital and already has that experience and knows how to get around red tape, or they shave off a ton of time and heartache in order to get that deal done.
Yeah, definitely. It's much better to get the deal done with partners. You don't get all of the money, but like they say, 50% of something is better than 100% of nothing. So at the end of the day, you just got to get the deal done.
Right. Just like the team, right? With Michael Jordan and all those
Yeah.
other amazing basketball players, that's what it is. It's a team effort. It's a team sport. And that is what I'm seeing again and again with all of the knowledge that I'm gaining and learning from so many amazing investors, is that there's so much to know, especially with assets that are so large and so many moving parts. And you're dealing with people's lives, right? You're dealing with needing to make sure providing a safe place for them as well. There's so many different aspects, and one person can't do it all alone.
Yeah, you can't. It's just too much work.
It's
Yes,
too much.
about some good people.
You mentioned in one of our conversations about deal size, and that I believe it was 5 million is harder to raise for than something like a larger funding raise. Can you talk to us about that, and what does the market look like?
Yeah, it was like I even talked about this on LinkedIn. It's much harder to get like a $5 million equity check versus like a 20 million. And I wouldn't say like 20 million is easier. It's more so that there's more appetite for $20 million checks, at least as far as like my relationships. Everybody's different, because if you're raising from like high net worth individuals, then the 5 million check is going to be easier every time, because you're dealing with people that, have a few million, and you're trying to get, 2, 3 million at a time, raise 5 million. But when you're dealing with like institutions, a lot of these groups, they may have like 20 billion in assets under management. They may have raised a fund of, 500 million that they're trying to deploy in 2026. And if they want to deploy 500 million this year, if they're doing $5 million checks, that's a lot of deals that they got to do. And that's a lot of deals they got to execute. Not just, they have to look at a lot more deals just to get the number of deals done. They'd rather deploy capital in bigger tranches than, doing the smaller checks. And at the same time, it's going to cost them the same with all the paperwork, the amount of effort in terms of, labor and underwriting and due diligence. So if you're going to do all that, you might as well deploy, because it's going to be, higher volume. You're going to get more of your money out. You're going to there's going to be better profit. So it's just much easier for them, a lot of them, to do 20 million or above, some 30 million and above. There's quite a few that's 30 million and above. Some will go down to like 10 million. Very few play in that like, 1 to 5, 1 to 10 million range. There's not that many groups. And those groups tend to have smaller pools of capital. So they're going to be very selective on what deals they're going to do. So that's one of the challenges. Why for equity, I tend to not even look at a deal until it gets to like the 10 to $12 million range and above.
If you can leave our audience with a summary, like your top 3 tips for raising capital, what would those top 3 tips be?
If we're speaking specifically on equity, I'll say the first one is know how to tell the story. That's the number one thing. Like equity raising is about storytelling, because at the end of the day, you have all these spreadsheets, you have these pitch decks, but it's going to be people on the other end of the table that are making that decision. So you got to appeal to them emotionally, not like literally, like telling a sob story or talk about, but you have to find a way to make make them emotionally interested, whether it's like, they think they're going to be able to make a great return or that they feel safe investing in this asset. You got to find a way to appeal to that. And that's going to be done through storytelling. Your deck is great. You need the numbers to work, but you got to be able to tell the story and convey that emotion that's going to incentivize that. Then they're going to look back at all the numbers and use numbers to justify their decision making. That's human nature with everything. Two, know what information to give. I think like when you're going through a deal and you're working on it for 6 months to a year before you start going to capital, you end up compiling a lot of information, a lot of data. And a lot of times that, a lot of that data could be overwhelming. So, confused mind says no. So you want to kind of pinpoint what's the most specific information that's going to really give them an idea of the deal and lead with that when you're talking to a funder. And then if they ask for additional, then it's good that you have it. You can send that over, but you don't necessarily need to put in everything because it's just too much information. It becomes information overload and it can kill the deal unnecessarily. Three, what would the third point be? I'll say just going back to being realistic, like understand what your particular deal is. And then you need to tailor your ask for that deal. Certain deals are going to make more sense for certain investors. So that's one thing I would say. You got to really research who you're asking for money. Understand what their directives are. What are they trying to get out of it? Are they more focused on cash flow? Are they focused on upside? Are they more worried about, protecting their downside in this particular market? Once you know that, you can tailor your ask, or that they may not be the group for you. So don't go into every pitch or every potential investor meeting just kind of blind. You want to know on the front end who you're talking to and make sure you tailor your ask to them in a way that makes sense.
Amazing. Thank you so much for sharing all your insights with us. If there was one question you wish I would have asked, what would it be?
I don't know, maybe why I transitioned.
Yeah, that's a great question. Share with us, please.
I transitioned from being in operations and acquisitions to focus on the capital side for really, I would say 3 main reasons. One is the flexibility of asset class. Because once you get into the finance side, yes, I still focus on but there's a lot more opportunity to work in different asset classes. So you get a little more variety, chance to work on different deals. Like I've only owned and operated but in capital, I've done stuff like in office and working on a mixed use deal right now. Like I've been able to get into different asset classes because you don't have to be as locked in on the deal. So you can be a little more fluid. Two is going to be the nature of the work. It's a lot more relational. It's a lot more conferences and networking, and I'm very social. So being able to talk to people and stuff like that, I just prefer doing that as opposed to like just being head down in the spreadsheet all day. And the third thing is just freedom of geography. You can do capital brokering pretty much anywhere and work on deals anywhere, whereas it's very much advantageous to own assets in the place where you live. Or if you own them in a different market, you need to be in that market pretty often. So those are 3 main reasons that I transitioned to the finance side, and also have longer term goals to be overseas and invest, or investing overseas. And that is something that I would need to be on the ground over there if I was to do it, versus if I'm on the finance side, I can, be here and work with assets overseas. So,
I love that. Big goals. What is 5 to 10 years? What does that look like from now?
So transition out of just multifamily to other asset classes, and out of real estate and other asset classes, private equity, business acquisitions globally, and all with this primary skill of finance and directing capital.
Amazing. Thank you so much for joining us, for sharing your wisdom with us and practical tips and tools that our audience can take away to maximize ROI. If our audience wants to get in touch with you, how can they do so?
They just look me up on LinkedIn, Sitta, and I'm pretty responsive on there. That's probably the best place to reach me.
Amazing. Thank you so much.
Yes, thank you. I'm happy to be here. Glad you had me on. I appreciate you putting this together.